Hello, everyone, and welcome to the FX Monthly webinar for May 2026. I'm Brian Dangerfield. I co-head G10 FX Strategy at NatWest, and I'll be your host for today's webinar. There's a lot going on in markets right now, very interesting times. Certainly with developments in U.S.-Iran tensions really changing really by the day here. But also, we've had a lot of developments in global central banks. We've had significant repricings in asset markets, significant repricing in energy markets, but maybe more muted moves in currency markets, certainly in the major currencies. And so today, we're going to focus a little bit on the U.S.-Iran war, where we are at the moment as we record today, cognizant that things are changing every day, but also on the U.S. outlook, because I feel like the dollar is still really in the driver's seat for global markets, that as the dollar is moving, that's really a big indicator into the fate of the major currencies around it. So we'll talk a little bit about the U.S. outlook and how we're thinking about the dollar as we're trying to balance these big moves in asset markets and big changes in the way that markets are interpreting the global growth outlook thanks to the war in Iran. Can you move to the first slide, please? So I'll start with just a very basic framework for thinking about the Iran war and how it might impact the dollar. And really two things coming to mind here. Just top of line um, factors that we think could be driving the dollar here. The first one is active combat. Is active combat happening or not? Which, of course, is a very important input into the market's assessment of not just the state of the conflict, but the future of the conflict. You need to stop the fighting before you have some return to normalization. And we've clearly already gotten to a point where it feels like the worst of the active combat may be behind us. That we've reached a ceasefire moment here. We'll talk about some of the domestic pressures facing the president in the United States, which might be motivating that push. We have certainly had moments where there had been risk of re-escalation and some, instances where the ceasefire has been reportedly violated. Um, but for the moment, those escalations have not led to the tit for tat style re-escalation that has led to a broad resumption of the war. And I think the market has seen and is pricing towards that the worst of the acute phase of the conflict is over, that the worst of the offensive action from the United States and Iran is over, and that the next step will be towards pushing the current temporary ceasefire into maybe something longer. The second driver that we've been watching is Strait of Hormuz normalization, which is related, of course, but separate to the active conflict, because there is at least a path, and we've seen some signs of the U.S. maybe pursuing this, that before the end of the war, that there could be normalization of energy supplies and other exporting supplies through the critical channel, whether that be U.S. enforced via the military of allowing ships to move through, this idea of this Project Freedom, which, as we record this in early May, began and has since been paused. Whether there's active efforts that are effective in reducing the acute risks for energy supplies, even before a peace deal, or even in the event of a re-escalation. So we're thinking about those things together as two broad drivers, with the best case scenario for the dollar being one of the worst case scenarios for global risk, being re-escalation, a failure of peace talks, where what is currently being priced in markets as a short-term disruption and a price shock in oil, the longer this conflict lasts, the longer we see actual supplies being reduced, the more that strategic and commercial stockpiles of energy are run down to counter this, the greater the risk that this price shock it transitions into a real supply shock, which has significant impacts for relative growth. As you move down this table here, we think about the more negative dollar scenarios, with, of course, the most negative being an outright peace deal where we see full normalization of the strait and also an end to active combat. Now, every day the discussions between the US and Iran are evolving. At the moment, we are in where I've highlighted in green here, which is a ceasefire without a normalization in the strait. And I think this is a US dollar stable situation that we found ourselves in, because we are through the worst of the active combat. At least that's the way the market appears to be pricing at the moment, which I think has seen the dollar come off of its highs. But to that same extent, we have not yet seen that normalization in energy supplies. And so the the risks to non-dollar economies, especially the risk to economies from lost oil supplies, are still very real. even if the worst of the active combat may be over. And so I think these are the forces that are pushing on the dollar right now. And if we think about the broad dollar, the dollar index, it's effectively at the middle of its range for 2026, despite everything going on. And I think that reflects the market trying to balance these two factors that the markets are clearly trying to price towards a growth in oil outlook that is better than the current one, a dollar outlook that is therefore weaker, while also being cognizant that the longer this crisis goes, that the more these risks to growth become a lot more severe, particularly for non-US economies given relatively higher exposures to Hormuz oil. Can you move to the next slide, please? I think one of the driving forces, certainly in the market in terms of expectations for the future of this crisis, is the domestic pressure being felt by the president at home. Not pictured on this slide is gasoline prices, average gasoline prices, which have moved up substantially in the United States to around $4.50 a gallon on average in the country. That compares to about $3 before the start of the war and even lower at the turn of the year. This is something that I think is a very clear indicator of inflation for most consumers. It obviously is a very damaging thing for domestic spending, discretionary income. If you have to spend more money every time you go to the pump, you're going to have less discretionary income to spend on things like restaurants and purchases. And so this really does hurt purchasing power. It increases inflation. And, in the minds of some, I think it violates the president's America First doctrine that avoiding foreign conflicts and reducing the price of energy was sort of a key piece of Trump's pledge in his campaign to the voters in 2024 that I think some feel has been violated. And I think that Trump is feeling this pressure, and I think it's why we've seen the market starting to try and price more towards the worst case scenarios being avoided now, and that future moves will be in the direction of de-escalation. And I think most people are looking at two really big benchmark moments for the conflict from the US political side. The first one is a Trump-Xi summit in China in just a few weeks here in mid-May. That a belief in the market is that the president wants to have a peace deal, a resolution in hand in time before that important meeting, in part because China is not only a large buyer of Middle Eastern oil, but also believed to be the main, if not the only major buyer of Iranian oil, despite U.S. secondary sanctions regime. And so the market, I think, has been looking at that meeting as a potential moment where Trump and the administration is actively trying to plan towards the crisis being effectively resolved. Now, we've already seen once that meeting has been delayed. So there's nothing to say that it couldn't be delayed again, and the market might take that any future delays there as a sign that maybe we might not get a resolution as quickly as some of the more recent media headlines have been suggesting. The other one, of course, is midterm elections in November, and we talked about this one on our FX monthly webinar a few months ago, the last time I joined. But the situation has not improved for the Republicans. If anything, it has gotten worse recently. And so Republicans, I think, are very wary that if gas prices do not come down in time for November elections, that they are going to be in some hot water. So on the left-hand side, we look at the generic ballot, which is a really good proxy of voter sentiment for the House of Representatives. And that what we show on the left-hand side is how Republicans are performing relative to Democrats over the last four midterm cycles. So that highlighted light green line on the left shows at a negative number, that's Democrats polling better than Republicans. And we're comparing this across the different cycles based on where we are, with the far right of that chart being the election day for that particular cycle. And what you see is that for most of this period, Democrats were polling well below where they were tracking in 2018, excuse me, which was the blue wave year where Democrats swept through the House of Representatives and crushed the Republicans. Now those numbers look a lot more on point with where Democrats were during that blue wave year. For most of this period, they were polling well below that number. And on the right side, you start to see some of what I think is the concern from the Republican and from the Trump side, is that Trump's approval rating has come down, and the generic Republican, which is that dark purple line, has effectively been treading water. What's maybe worrying them a bit is that on the generic ballot side, the Democrats are currently enjoying their best polling since the election in 2024. Now, is this a mirage? Is this something that's just market or voter frustration with current gas prices? Is it voter frustration with the president? Is it voter frustration with the Republicans that's feeding into Democratic strength? Or is this something greater for Democrats? We won't find out until we see oil prices actually come down or an end to the war, and if that happens in time. But I think this is something that I think certainly the politicos in the Republican Party and the president are probably tracking very closely. Is if Democrats are starting to pull better, not just Republicans pulling worse, I think that's something that's clearly putting pressure on them. And I think that's motivating how markets are pricing towards better outcomes and towards maybe the worst of the crisis being over. Though there's an obvious sense that that re-escalation is still a very clear risk for the dollar. Can you go to the next slide, please? So one of the things that we've been tracking through all of this is positioning and relative growth. On the positioning side, a few months ago when I hosted this webinar, I showed the same chart on the left-hand side just to show one estimate of market positioning in the dollar. That dark purple line on the left-hand side, you could see on the right where it kind of bottomed out and has since shot up. That's dollar positioning going from sharply negative, sharply short the dollar, to being quite long the dollar relative to recent history. And I think that reflects the big shift in relative growth expectations that came at the initial start of the war. And we show that on the right-hand side, which is the GDP growth estimate, the consensus on Bloomberg for various economies. Now, you've seen a down tilt in each of those, but off of a lower base in non-dollar economies. So the relative spread in terms of expectations for growth, quite a bit larger in terms of markets see the relative exposure to energy markets in non-dollar economies. The United States is a net energy exporter. Most of its oil that it does imports does not come from the sea. It comes from Canada primarily through pipeline. And the US does not import a lot of oil specifically from the Strait of Hormuz or from the Persian Gulf altogether. And so that is a sharp differentiator versus Asian economies, which are in particular heavily exposed. Their energy import basket is much more heavily exposed. And so relative growth did shift in favor of the dollar. Expectations, I think, did shift in favor of the dollar. And positioning has moved from very short of dollars to neutral, if not outright long of dollars. And I feel like that's been a big part of this initial move is that the dollar is stronger, but it's not much stronger than it was at the start of the conflict when you look at the entirety of the picture. And I think that part of this is that the market sees positioning having adjusted in the first order, and the second one being that while we've seen a shift in relative growth expectations, we haven't necessarily seen as big a shift in underlying fundamentals on the interest rate side, which normally has a really big role to play in the dollar. And so as we're thinking about why the dollar response has been so muted compared to say where we were in 2022, I think those factors really do play an important role. Can you go to the next slide, please? So as we think about the United States and where we might be with the Federal Reserve, markets have adjusted hawkishly in pretty much every major economy on Earth. That's a natural response to higher energy prices and exogenous shock to inflation. That the inflation growth trade-off that central banks are facing when you put a big hawkish higher inflation input, that's going to elicit a response. And what we've seen in interest rate markets broadly, not just in the US, but everywhere, is markets have repriced sharply in the hawkish direction. Interest rates have risen in those, especially in those short tenors. What we're watching very closely, and what we think the Fed is watching very closely, is the difference between goods inflation and services inflation. On the goods side, you absolutely see signs that goods inflation has moved up. A couple of things driving this. First has been tariff impacts. Over time, we're getting more confidence that tariff increases that we saw during last year are being passed through to consumers. And now you're layering on higher energy prices into goods price inflation. And that wouldn't just come from energy, it would come from secondary drivers. So, energy not only goes into, into goods directly, but it also goes into goods in a non-direct sense. So transportation of goods, for example, the cost of energy, obviously very important into that. And so you could see primary and secondary impacts from higher oil prices that would feed into higher goods inflation. But critically, on the services side, you have continued to see services inflation has come down over time. And an important driver of that has been wage growth. And wage growth in the US has continued to moderate. And that's in part due to a very soft labor market, that the labor market is just not generating a lot of demand for labor right now. Job growth has slowed pretty materially from where it was just a few years ago. And we have a lot of evidence that demand for labor has come down. And so, as demand for labor comes down, expectations for wage growth come down with it. That if businesses are not bidding up for employees, then they're not raising wages to try and bid for those employees. And so, as we see on the right hand side here, the employment cost index for services producing industries is a pretty good relationship with core inflation, specifically on the services side. And so this is the I think every central bank is in this mode, but the Fed especially I feel like is in this position, which is we have goods price inflation coming from factors we cannot control, but we have services inflation, which is more, we think, demand driven, where we're seeing potential continued downside pressure because the labor market is not strong enough, they think, to push wages higher. And so this is a good recipe for trying to what we call look through higher inflation. The last time the Fed looked through what it thought was a temporary inflation surge, it got burned really, really badly. And I think it's understandable that they come into this particular version of higher goods-based inflation, higher energy-based inflation, with a more cautious approach than they did during the heart of the pandemic when they looked through a lot of the pandemic inflation and got burned very badly by it. But if services inflation can continue to come down and the US economy not as strong now as we know it was in the immediate aftermath of the pandemic with hindsight, then we still think the Fed can be on path to reduce interest rates later this year. Right now, I feel like we're still in the throes of uncertainty around higher oil prices, the Iran war. It could get a lot worse, could get a lot better. I think we all understand that. The volatility there is still quite significant. If you can go to the next slide, please. We still expect interest rates in the United States to come down at the end of the year. The market is effectively priced for no change at this point. That's really reflecting those higher energy prices. We have the Fed resuming easing in October. And that's something that, because we see services inflation continue to come down, if we get to a steady state for energy prices where energy related risks do end up being lower, which is certainly the direction the market is trying to price towards, that could embolden the Fed under new leadership from incoming Fed Chair Warsh to push for lower rates later in the year. Relative interest rates are a very important piece of dollar valuations. This is something we show on the left side. If you're a frequent consumer of this webinar series, you'll have seen me produce and highlight this chart before, this picture before, and you'll certainly see it again if you continue to watch this series. But this shows the dollar index relative to two-year interest rate differentials between the United States and its DXY rated peers. So this is primarily the euro, but also some other currencies that go into the DXY basket. And what you see is that for a long time, this relationship has been very, very tight. That as US interest rates are moving up relative to their peers, which is the blue line, the light blue line moving higher, then that's a big driver. It's a coincident indicator with the dollar strengthening against its global peers. Now, since Liberation Day tariffs, specifically in kind of in April of last year, this relationship showed some signs of weakening. And so we don't want to discount that and say that this relationship is as strong as it once was. That's an important input into this discussion. But even so, what you have seen is that through this crisis, we have not seen interest rate differentials surge in favor of the dollar. That's a huge difference between this period and where we were in 2022. So you can see in 2022, during the Russia-Ukraine crisis in early 2022, that's on the left-hand side of the left chart, that US interest rate differentials surged in its favor. In this particular crisis, you just have not seen that. And as I mentioned, a big part of that is that the hawkish adjustment in interest rate expectations has come across economies, across jurisdiction. It's come in the United States. It's come in Europe. It's come in the United Kingdom. It's come in a lot of different economies, and that's meant that interest rate differentials throughout this crisis have not been arguing for a sharply stronger dollar. And so we continue to think that with interest rate differentials not necessarily signaling a much stronger dollar, the market leaning in the maybe more optimistic direction. We'll see if that's validated by upcoming discussions, certainly as we head towards the Trump-Xi meeting. And we think the Fed is going to resume easing in the back half of this year. That in combination with some longer term factors such as continued pressure from de-dollarization, we think continues to point towards a weaker dollar as the base case as a medium term strategic consideration. On the technical side, I think we, like everyone else, is effectively paralyzed under the possibility of re-escalation as a potential driver of a stronger dollar or de-escalation as a driver of a weaker dollar. But we do think that medium-term picture continues to point towards a weaker dollar, and we think some of the fundamental factors continue to support that even through this latest crisis. Can you go to the next slide, please? Finally, a few words on sterling. Sterling has been relatively resilient through this period. And I think that surprised a lot of people. It surprised certainly in our discussions with clients that if you look at the performance of foreign currencies throughout this, throughout the Iran war, that sterling has been one of the relatively strong performers. And I think that in part reflects market expectations around the Bank of England. The Bank of England had been priced very aggressively dovish heading into the crisis. The market, I think, had become very confident that the Bank of England was heading towards consecutive interest rate cuts because growth has weakened. But they still have services inflation that is uncomfortably high in the United Kingdom. And so the market priced back a lot of those expectations when the war started because inflation is already uncomfortably high. And when you've taken this, the war into account, that's pushed inflation expectations, it's pushed the market's assessment of the Bank of England's willingness or ability to ease policy. It's sort of pushed that into the long grass, if you will. And so I think that's been part of the reason why sterling has shown some relative resilience, including against euro. I think that's been a part of that relative resilience, which in some cases I think can be called surprising given the energy exposures and also the UK's growth position. Another factor that we are very closely watching is fiscal policy. That long-term interest rates in the United Kingdom have started to show more clear signs of underperformance. There's certainly some local political drivers coming up in the very near term that I think markets are focused on as a potential flashpoint for future concerns around future budgets, fiscal responsibility, those types of concerns. I think, those are still percolating in the market. They never really went away. There have certainly been periods where the market has been more focused on fiscal risks for the United Kingdom and for sterling. And so we're keeping a close eye on those political developments and fiscal policy, because we've certainly seen periods where fiscal policy has played a larger role in weighing on a sterling FX, and with some recent underperformance in longer term gilts relative to their G4 peers, there's some risks there coming from the fiscal side that could bleed into sterling FX. So with that, I will pause and pass to Piers Leslie to discuss more about technicals. Piers, over to you.
Thank you very much, Brian. Very interesting as ever. Very interesting there. And I agree with you about the dollar index and how important the dollar will be on all markets. So, in fact, having said that, let's start on the dollar index. Well, actually, let's start with my introduction. So we go just to the first page. I think something I spoke about last month was that in January, in my start of year outlook, I said it's not what's known in the price, it's what's unknown. Those unforecast shocks that can hit and blindside the markets. And I said that I gave a few dates to watch, and the first date I gave to watch was the first week in February. The second date I gave to watch was the first week in March. And then I said, look, watch the whole of April. And I think those have worked quite well, because when we look back, we saw the first week of February, saw a lot of volatility after the announcement of the Kevin Walsh being announced the next Fed Reserve on the Friday before. The first week in March was the first time the markets had a chance to react to Operation Epic Fury. And that happened at the weekend before, but the first week in March. And then I said about April. And April, we saw a very volatile start to the month, as we had the statements such as a whole civilization will die tonight. never to be bought back again. I don't want that to happen, but it probably will. So that caused a lot of volatility at the start of the month, where the market took one thing and then nothing happened, so it fell back. But it also ended the month with a lot of volatility, because we saw the Bank of Japan come in and intervene for the first time since 2024. So the first time in a couple of years, Bank of Japan in. So it was a volatile time. And as we head into May, I still think we can see volatility. Maybe this week might just see a bit of volatility. I've written here, and I did write these at the beginning of the week. Then sort of the 12th to the 15th, just going into that mid-month area, is another potential risk area for volatility. And then around the end of the month, I think some volatility will sort of pick back up again. But I don't think this year has finished with its ability to provide us with some unprepared shocks and volatility to the market. But let's go to the dollar index first, because that is what drives FX markets. On the next slide, that's it, that's the one. So here is a very important dollar index slide. It's the quarterly index slide. And what I really like about this slide is it shows why the market has stopped in both directions, on the upside and the downside. So you'll have heard about people saying the trend is your friend in markets. So you always want to know where the trend is. And what's held the dollar index for over a year now, so for 5 quarters, that black dashed trend line has held the dollar index. So the market comes down there. So the sellers are selling it, but the buyers are on the trend line buying it. So the trend followers are still trying to buy it, saying, look, we can't see that the trend has broken yet. So they're buying the trend line, which is why it's worked so perfectly on the last sort of 5 quarters as support. You've had tests below it. By the end of the quarter, it always comes back up. But what about resistance? We know where the support is. It's that trend line. But the resistance is simply those 2 orange lines above. And it's very mathematical, very simple. If you look back to 2015 to 20, the highs in the market were between 100.7 and 101.40 area. And if you draw those lines across, you'll see that when price broke above it in 2022, the dollar surged up, that it switches from what's called resistance to support, the rule of polarity. So every move down through 2022, 23, 24, and the first part of 25, that held those initial moves down. But then in 2025, it broke through it. So it broke through it and went to the trend line. When the rallies have come, you can see each of those previous quarters, the last 3 quarters, where have they stalled? The rallies have simply stalled at that orange band. And that's called the rule of polarity. So to get positive on the dollar, you need to see price above the 101, 102 area, really. It needs to break through there. If it breaks the trend line, then it looks like coming down towards the 93 area, the top of that cloud. But because it's a couple of months till the end of the quarter, on the next slide, I've looked at the monthly chart. And this gives us a bit more chance to react quicker. So there again, you can see I've written support, resistance in those 2 orange bands. So we know where that is and we know why it's there. We don't need to keep looking at that, but you can see how it's reacted as support and resistance very well through the 2020s. Now, the trend line. Here is the trend line on a monthly basis. And you can see that for a year now, it has hit that trend line, bounced, hit the trend line, bounced, hit the trend line, had a wobble. It had one close below and then came back with a positive session. So what you need to get a true break of a trend line is 2 negative closes below that trend line, or 2 sessions below it if you're conservative. And that constitutes a break of the trend line. And then we will see that dollar strength disappear and the weakness come as the sellers have overcome the trend buys on that trend line. And then we could go down to sort of towards the 93, 91, 92 area where the next main support is located. So at the moment, it's the trend line you're watching against that 100, 102 area. And I think if you were just trying to think about the dollar, I would just watch that trend line as the month goes on. How are we in relation to that trend line? That tells you what the market's thinking on the dollar, whether they want to be short or long the dollar. At the moment, it's just walking along that trend line. You want to see a breakaway from it, a clear breakaway. So that's the dollar index, but how does that impact the currencies we look at? So we go to the first chart now. We've got sterling dollar. So this is probably one of my favorite sterling dollar charts because I've managed to use this since the 80s and 90s. So this is the move down from 1980 to 1984. Every rally and fall has been held by these retracements. And it's one of the great ways to use long-term charts because they warn you ahead of getting to an area, this is where the market's going to sell. Remember, they're mathematical markets. They need somewhere to have a target to aim for, and that's where people will take profit or cut out, but they want a profit area to look for. So these lines, the Fibonacci retracements, are very helpful for that. And that's why earlier this year I said, watch that 23.6%, sort of 137.88, sort of 138 area. Watch that. Every rally since Brexit has been capped by that. I said it last year on these webinars, and it capped it last year. I said it at the start of the year on the January one, and it capped it that month. And we haven't managed to break above it yet. We could break above it, and then we have to change our view. But at the moment, that's a key resistance area, that 138 area. So if we go to the next slide, we can't wait a year. So let's try and go into shorter term charts to try and have a better look where the market is. Now, the next chart, this chart, I don't want to go to the next chart on there, but this chart is the quarterly sterling dollar chart, and it explains why prices stopped where they are. So these are Fibonacci extensions, the pink lines. You take the original rally, and in the same percentages that we look at for retracements, you extend them on once the market starts to rally again. So we've taken that 2022 to 2023 rally, you get the pullback, then you put the extensions on. And again, it shows just how mathematical the market is. It wants to know, where's the target? Where should I take profit? Where should I buy? Where should I sell? And you can see on this chart how prices simply use those for the last 3 years, but especially you can see the 38.2% area as support. So that's the buying opportunities, and the 61.8% as resistance, that's the selling opportunities. And if you look back on this chart, you can see that for over a year now, the market has simply gone sideways, sterling dollar, between those two levels. And so you really need to get a clear break of those two levels to start to think that the market is changing. So I think to signify a break to the upside, I'd like to see a monthly close above 139.60. And then that's a bit of a faster warning that, hey, look, longer term, this has got the trigger and we could be going higher. So I'd watch that 138, 139.60 as a 1.5 cent buffer on the top. And then support. Well, the 131.25 area here is the 38.2. And you can see that we haven't managed to have a quarterly close outside that. So I'd keep that figure in the back of my mind as a support area. If you start to get below that, I'd be starting to think, why are we down below there? But at the moment, when the market's going sideways, you just have to live with the markets going sideways. What you're looking for is a break. And when you get that break, you follow the break. Go with the break. Now, that's the resistance that I see on this chart. But on the next slide, I'm going to look at support. So this is what I call the battle map. It's the same lines from January. I had this one in January. The 38.2% retracement is the key retracement I always talk about. 38.2, 61.8, key ones in FX. We can see the rally of 2020-25, every pullback has always stopped on a monthly basis and been held by the 38.2% at 131.30, well, 131.32. I don't believe that's just coincidence. I don't believe that every month that it got there, that some event happened that, oh, we've all got to change our view. I think it's just mathematical. People there think, right, if we're buying this is where we buy. This is a good opportunity. And they keep making money. So while you're above 38.2%, your impulsive uptrend is intact. Yes, it's still an uptrend because 2022, we're down near parity, and it's been going up with higher highs and higher lows since 2023. But that's on the monthly chart. So it's different to the quarterly chart. You can see it here as well. We've just been going sideways for the last 12 months. So where do things change? So if we get below the 131.25.30 area, that's going to be quite a big shock for sterling dollar. So that's where I'd have my support. If you start to get below there, 129.5 is the next area, and then 127.30 area. But you've really got to watch, if you want sterling dollar, that we hold above this 131 area in sterling dollar. And again, I've highlighted that 139.60, 139.90 area, stop the Bollinger Bands. I think that's where you need to break above to show that, yes, we're making higher highs again, the higher lows have stayed, and we're definitely, the uptrend's got more legs to it. Because it's just going sideways for the last year. It needs some impetus, something to sort of kick it along. Now, if we go to the next slide. This is zoomed in. I always forget this, that I zoom in to make it better for the presentations. But here you can see a bit clearer the 131.30 area as the 38.2%. So it never hurts to reiterate these. But you can see clearer how important that 131.30 area is. Or, 131, that whole area. And so we can now move on to the next slide. Sterling euro. This is from January, start of year webinar. And this is why long-term charts are very important. There's a lot of money that trades on long-term charts. People want a long-term position. There's a lot of money that also goes on short-term charts. But the long-term charts, you can see so well here. Since Brexit, the 38.2% retracement has held every rally all the way across. Last year, you can see last year is the red candle, very negative year for sterling. You don't see it so much sterling dollar. Sterling dollar looks like a sideways year last year. But sterling against euro, but that sterling dollar move up was just because the dollar weakened. And, euro dollar, everything. You just saw big dollar weakening. But here, you see sterling, very massive weakening. So this year, I said in January, watch the 116.09 area. If we go to the next slide, you can see how well that's worked. I mean, on some systems, it shows 116.11 as having been the high. But basically, that 116.09 has capped the market. It's where we're sort of trading now. So price is trying to push up at that area. And where's above that? The 118.5 area, 118.40, the 20-period moving average. So if you do break above that, that's another area to watch as we go up. And you're always looking for the rule of confirmation. It's like when you see someone and you're trying to decide if you like them, you go and chat to them. If you see them and then you chat to them and you like their conversation, it's confirmation you like the person even more. So here, if we go to the next slide, this is the monthly candle chart from last month. So on this monthly candle chart, you have that yellow shaded in area, and that's something called the Ichimoku cloud. And rather than try and give a whole lesson on it, it's basically a historical lagging moving average, but it's something the market uses a lot. And there's a good proof of that with this chart in that, since 2022, every drop down in sterling euro has been held on a monthly close basis by that cloud. So last month, I was saying the cloud is the support, the bottom between that 112.75, 114.04. Resistance, we had that orange line coming in, which was around 116.06. And then the 116.50 area from the 38.2% retracement. And if we go to the next slide, you can see how that has worked well. So for 4 months now, when it's hit that 116.06, the market stopped. Now, to me, that's not a coincidence. Some people might say, oh, yeah, just coincidence. But it's stopping right at that line. But last month was the highest monthly close. So we can't take away from the fact that, look, this is trying to have a good attack higher. But at the moment, it's still stopping at that 116.06 area. Where can you get confident on sterling euro? You need to see sterling euro above 116.5, 116.60 sort of area. A monthly close above that, and that could see the door open for 117.5, 118.5 area, where the next main resistance will sort of come in. And remember, the sort of 118.40 area ties in with the moving average we saw on the other chart. So that should be an area of resistance if we break through that 116.60. Because for the moment, that remains the resistance, 116.06, 116.54. Because if price falls off that, it could go back into the cloud. But now I sort of see support in the 112.65, 114 area. So there's about 1.5 cent range there, which should act as support. Now, if you were to break below that, then that would be very negative for sterling and open another sort of leg lower sterling euro. But those are the areas I sort of watch. 112.50, 113.40 is your support against that 116.5 area as resistance. And the final chart is euro dollar. Euro dollar, to me, it's been very simple for the last sort of year. You had the move up, and if you look at those pink projection lines on the side, you can see it's just walked up those lines. It got to the 100% extension, which was around the 119 area, and it stalled. So as an extension, it stalled at the 100% area. So now we look at the retracements. The retracements, 115.08. Look, surprise, surprise, where the low's been in euro dollar at the first retracement. It's a mathematically traded market. So it's just going sideways. Look at that since 2025, sideways push in euro dollar. Where do things change? If you start to get below sort of the 113, 115 area, you'd have to worry if you are trying to follow this uptrend up. It'd be the first signs that something's starting to crack. Confirmed, I feel, by if you see it below 112.5. But while you're above that support, what the bulls are looking to take out is the 118, 119.20 area. You really want to see price above 119.20, and then it might sort of target up towards the 121.40, 123.25 area. But at the moment, I can't see anything on the chart that tells me it's going to be outside 113, 115, 119, 121 at the moment. Still looks a bit sideways. But wait for a break. I think a break will come. But I'll keep you posted on the weekly charts that I send out. They're a bit more long-term, and on these webinars. But I hope you found that useful. And finally, I must say, my disclaimer page disclaims me from everything. I love this page. Anyway, I hope that was useful. Any questions that your NatWest salesperson know, and I'll come back and answer them.
Great. Thank you very much, Piers. Insightful and interesting as always. That concludes this edition of the FX Monthly Webinar. Thank you so much for listening.